So factors that affect cash needs, we have first of all terms of purchase and sale. Like I said, what decides or what type of terms and conditions are there in case of your purchases and sales. How much time period, that is, your suppliers allow you, and how much time period you allow your debtors, isn't it? Same way, what is the cash cycle? How quickly does the cash move in and out of your business? Okay, how much cash, how fast the cash gets converted into raw material, finished goods, and sales, and then based on whether you sell on cash or credit, how much of it or how quickly it gets converted back into cash. Then also you have the timing of the inflows and outflows. It may not always match. For example, when certain expenses become due, like salary becomes due at the end of the month, you have to pay. It's not, you cannot guarantee that that inflows will also come at the same time. It's not possible for you to guarantee that you will suddenly make sales and collect a lot of money from your debtors during that point. Okay. Then lastly, we also saw the nature of demand for the firm's products, and we said whenever there are uncertain demand or any type of elastic demand type of products and services, we need a very high cash balance, because at any point of time we may have to produce more and sell more. But at the same time, if they are the type of businesses where the demand remains constant no matter what, right? Too many things do not affect the demand of such utilities or such services. So in that case, you may not require a very high cash balance. Okay, let's see the fifth problem. The fifth point. This is related to your current liabilities, which are a big source of, they are a big mode of your outflows, manner in which money goes out, and also we are interested in their maturity periods. So the different current liabilities that generally businesses may have at any given point of time would be classified into these main ones. So what type of current liabilities do we have normally in a business? So let's take commonly liability side of any balance sheet, and you will have current liabilities like short-term loans, right? Businesses take loans from banks. The short-term ones get classified under current liabilities. Okay, the long-term ones are of course borrowings. Then you have things like sundry creditors, money which you owe your suppliers, which is supposed to pay them, isn't it? Then you have other things like bank overdraft, which is also a type of loan that you take from a bank. Okay, further down you will have other expenses, outstanding expenses. Okay, all other types of expenses that are payable, and these are going to include bills payable. Okay, you will have any outstanding taxes to be paid or provision on taxes. Then you have dividends which are payable. You may have any salaries that are still outstanding, and so on. So these are your current liabilities. The generally current liabilities that are normally seen and most commonly seen in any given balance sheet. And these current liabilities, they have different maturity periods. Now, what do I mean by maturity periods of current liabilities? It's basically about when you have to pay or when these current liabilities become due. For example, short-term loans. Short-term loans are given for less than 1 year, right? The bank gives you short-term loans for about 1 year, even up to 3 years, and these have to be paid within that much time. They have to be repaid within that much time. So let's say this maturity period is after 1 year. Okay, same way sundry creditors. Let's take on an average, all your sundry creditors have given you about 6 months to make the payment for the goods which you have purchased. Your bank overdraft, let's say moreover 2 months are given to you to pay the bank overdraft money. Again, other type of expenses like bills, taxes, dividends, they may have different time limits like 3 months. Dividends you have to pay, let's say, within 6 months to your shareholders after having the board of directors, the shareholder meeting. And then salaries, let's take another 2 months for salaries. So all of these current liabilities are going to become due after these maturity periods, right, at the end of these maturity periods. So that means you have that much time to arrange for cash in order to pay these current liabilities. Am I right? For example, the short-term loan. The loan is of 1 year, okay, and you can repay that loan in that 1 year. That means you're paying all those EMIs, or maybe you are going to pay at once. Alright, whatever loan you have taken, you will pay at once at the end of the year. So, same way sundry creditors, they have given you about 6 months. So, you are going to need cash at the end of the 6 months to make the payment. So, what we're saying here is, the longer the maturity periods of the current liabilities, okay, the lesser will be the cash reserve requirement. Like for example, in case of compare sundry creditors with bank overdraft. For bank overdraft, you need to keep the money ready within 2 months to repay. Whereas for sundry creditors, you have at least 6 months time in order to make that payment. Isn't it? So, of these two, where will be the cash reserve requirement the highest? Over here, you will need a lot of cash reserve. Whereas in case of the sundry creditors, you will need a lesser cash reserve. Why? Because you have time. There is a longer duration that is allowed to you to make the payments. So within that time, you can arrange for the cash, right, as conveniently as you can. But for bank overdraft, you have just 2 months time. And within 2 months time, you need to have a good cash reserve, a bigger cash reserve in order to make that payment. Is this clear? So as far as maturity periods are concerned, this is how it works. Longer the duration, lesser the cash requirement, and vice versa. Fine? Okay. Similarly, the amounts of all these current liabilities. Okay. So more the current liabilities that you have, that is the larger the amount of the current liabilities, the larger will be the cash reserve required. Like for example, let's say all of this adds up to some good 1 lakh rupees or more. Yes, you have to make this 1 lakh available. You have to have that much reserve so that as and when these current liabilities become due, they become payable. You have money, you have the cash in order to pay them. Okay, so in this case, higher the amount of current liabilities, higher will be cash reserve, and vice versa. So if you don't have a lot of current liabilities in the business, that means you don't do too much business on credit and you pay off your creditors as soon as possible, then the cash reserve requirement will be also less. Fine. So this is as far as the amount and also the maturity periods of current liabilities concerned. Right, so that was our 5th point. The 6th point we are going to see is the seasonality of operations. Okay, now most firms or a lot of firms, they have or their businesses are affected by seasonal operations. Okay, that means they will require a lot of cash and a lot of working capital during certain peak seasons, and then that requirement falls or is not needed as much during the off seasons. Followed? So seasonal operations is what they have. There will be certain times of the year or even within a month there will be certain times of that month during which the business picks up, it has a lot of demand, and then again there will be certain days of that month wherein you will not see so much demand and there will be a fall in the requirement of the working capital. Okay, so in such cases you have to decide as to how much cash reserve requirement you need to maintain in which of these seasons. Okay, let's take an example here. Say you have industries like fishing or tourism. These are very much dependent on seasons, like the actual geographical seasons, right? And they will be affected and they will be seasonal, their operations will be seasonal based on the time of the year. So let's say tourism in Goa for that matter. Things like tourism in Goa is mostly dependent upon things like beaches, about water sports, adventure and so on. Okay, and it cannot take place during the monsoons. Like during the monsoons you will see a sort of slowdown in these activities, or these activities will not be conducted at all. Okay, similarly, let's say you have colder places like where it snows. Okay, then these places like Shimla for example in Himachal Pradesh, these places are dependent on the snow for all their tourism related activities like skiing and all other type of snow related sports, right? And it's going to be during only those months. It's not going to snow around the year. Okay, you won't have snowfall around the year, and those types of businesses will last only during that particular time. Is this clear? So based on such seasonal conditions, these businesses will need working capital, or they will need that much amount of cash in order to meet with those seasonal demands, right? And during other times their demands are going to be much lesser. Okay, so what happens here is during a peak season where the demand is more, you're also going to need a high cash reserve, and other seasons we call it the off season also sometimes, especially in hotel industries, the cash reserve is going to be much lesser. You won't really need as much cash in your business. Okay, it's not just about seasons in the sense that you have to relate it with geographical seasons like monsoons, winter and summer. Okay, it can be any other changes that take place. It could be festivals. So let's say around festivals there are some businesses that pick up a lot of business. You have all these online sales and online big shopping festivals that happen only during certain seasons, like the festival seasons around Diwali or around Christmas and so on. So it doesn't always have to do with geographical seasons, but it may also be related to such circumstances. Okay, on the other hand, there are certain businesses that don't change with seasonal conditions. Okay, like for example, household items, groceries, toiletries, soaps and toothpaste and things like that, or even other food products, the vegetables, the fruits and the grains, food grains that you eat, the demand for them is not seasonal. They are demanded throughout the year. So if you look at an FMCG company, it stands for fast moving consumer goods, and this includes all your companies like Hindustan Unilever Limited, you have Patanjali, you have ITC. They are engaged in manufacturing of soaps and biscuits and all these other things, day-to-day household items, correct? Their business is not seasonal. It's not like we buy soaps only during summers, or it's not like we buy biscuits only during winters. We buy them throughout the year, and the demand for it or their production levels remain consistent throughout the year. So in such cases, the cash requirement will also be stable. Okay, stable cash requirement, neither too high nor too less. It remains consistent, it remains stable throughout the year. Is that fine? So that is with relation to seasonality of operations. This is different from the previous point that we have done related to your nature of demand. Okay, demand is whether it's based on whether it is elastic or inelastic, whether this is based on operations, your production, how much you produce based on the seasons that your business is going through.